Okay, thanks a lot for the invitation. So my name is Leyla, I'm from the finance department, and today I'm going to talk about the information-driven volatility and return. So today I'm going to talk about a fundamental concept in finance, which is the relationship between risk and return. Then when we think about the investment, then the standard finance models always tell us the higher risk should come with higher return to reward for taking on this risk. So in the stock market, we typically measure the risk using the volatility. So then when the markets are very volatile, as we have seen recently, then we would expect the future returns to increase in order to compensate for taking on this risk. However, this is the puzzle. If we take a look at data, we found the opposite. So the periods of high market volatility are often followed by lower, not higher returns. Then this is a problem because it contradicts to our basic understanding of investment. So then, why this is happening? So the purpose of this paper is to provide a new explanation to address this puzzle. So then it turns out what matters is the source of volatility. So we show that when the volatility is driven by information, then for example, big news or the policy announcements, then the higher past volatility is actually associated with lower future returns. So this is the topic I'm going to talk about today. How does the information influence the volatility and the return, and why it can help us to understand the puzzle in the data. So then, let me just give you a simple example. Suppose the volatility of the S&P 500 was really high in March 2025. And then the standard finance theory would just tell us the April 2025 return should be higher in order to compensate for the investor to taking on this risk. And otherwise, the investor would just step out of the stock market during these turbulent times. However, if we take a look at the data, the April returns tend to be lower. So then we formally test this using this following regression. We just regress the monthly future returns on the monthly past realized volatility. And then regression coefficient is significantly negative of around negative 0.60, which means that the higher past volatility can predict lower future returns. So then, in finance, we care about how to make money. And also, you guys also care about how to make money. So then, in fact, this is a famous trading strategy that based on this fact, which is called a volatility managed portfolio. So here is how it works, or here is what you want to trade. So if you take a look at past month's realized volatility, if it is very low, then you just invest more into current month S&P 500. However, if the past month realized volatility is very high, you just invest less into current month's S&P 500. We all know that passively investing in S&P 500 gives us an average return of 7% per year. But the volatility managed portfolio can produce an average return of 9% per year, which is 2% higher than the market portfolio. And then, just simply by adjusting how much you invest into the S&P 500 based on past month's volatility. Very simple. Then, the question is, how does our theory differ from the traditional theories to understand this phenomenon? So first, we need to understand a very important, we need to distinguish between two important concepts, which is the difference between the realized volatility and the expected volatility. So the realized volatility means how much the market moved in the past. So it's backward looking. But the expected volatility is in expectation form. So it reflects how much you think in the future the market will move. And then any finance models, including ours, must imply there's one relationship must hold in expectation, which is the future expected volatility must be positively correlated with future expected returns. So in simple terms, if you expect future risk is higher, then you want higher returns in the future to compensate for this risk. But then the question is, how is the past realized volatility correlated with future expected volatility? Then to answer this question, the standard finance models just assume that the volatility of the stock market is driven by macroeconomic fundamentals, for example, the consumption or firm production. And then because volatility in the data is highly persistent, meaning that if this month volatility is very high, then it is likely next month volatility is also going to be really high. Then these types of models will just tell us the volatility is, past realized volatility positively predicts future expected volatility, and therefore positively predicts future expected returns. However, our paper is different. So we show that if the volatility is driven by information, then past realized volatility negatively predicts future expected volatility, therefore negatively predicts future expected returns as in the data. So then the best way to understand our information-driven volatility channel is through the various decomposition formulas. So then we think of the stock market as a claim to the aggregate consumption C, which realizes in the future at a time big T. So the total variance of the consumption can be decomposed into two parts. So the first part is the variance of the conditional expectation. So this depends on the information S that arrives at the stock market, for example, today. And then this means that how much the stock market responds to today's news. And this is what we call the realized volatility. And then the second part is the expectation of the conditional variance. So this reflects how much uncertainty remains in the future after the information release, and or how much risk remains in the future. So that's what we call the future expected volatility. So the traditional models inject shocks to the volatility of the aggregate macroeconomic fundamentals on the left-hand side directly. Then because volatility itself is persistent, past realized volatility positively predicts future expected volatility. However, if we just keep the total volatility on the left-hand side fixed as constant, but inject shocks to the quality of information in ST, the more precise information must trigger large movements in the stock market because it resolves a lot of uncertainty. So the first term, the realized volatility, must be higher. So mechanically, the second term must be smaller, which means that the future expected volatility has to be smaller because the sum of them has to be a constant. So this is what we call the information-driven volatility. So to be more precise, information-driven volatility refers to the fact that the time-varying information can induce a negative correlation between the past realized volatility and future expected volatility. So here's the intuition. So suppose then today there's a very informative news. Suppose Jerome Powell just said, okay, the Fed is going to lower the interest rate by 25 basis points today. And then the market must move a lot because there's a lot of uncertainty just got resolved. And then at the same time, so the remaining uncertainty in the market must be smaller, so the future risk must be smaller, so the future expected volatility will be smaller, so the future expected returns will also be smaller. So then we want to formally test this mechanism in the data. So first we will need to identify the informational days. So then which are those days that contain a lot of big news. So we use two types of events. First, we use the S&P 500 return is either above 2.5% daily return or below negative 2.5%, together with big news coverage in the newspaper. And second, we use the monetary policy announcements from the Federal Reserve. So then we need to measure the informativeness of the news. So how do you do that? We use the VIX index, because the VIX index reflects the market expected implied volatility in the future, which is derived from the option prices. So basically, the VIX index just measures the uncertainty in the stock market. Then we define the implied variance reduction, which is delta IV, as the VIX square before the information event minus the VIX square after the information event. So then if the implied variance reduction is very high, it just means that the news resolves a lot of uncertainty. So the realized variance is very high upon the revelation of the news. And then it means this news is very, very informative. So then we want to predict two things, which is implied by our model. First, we show that this more informative news triggers a large variation in the return upon the revelation of the news. At the same time, it is associated with lower expected variance in the future. And the second, we want to show more informative news is associated with lower returns in the future after the revelation of the news. So then how do we do that? We first want to test the first implication, which is more informative news is associated with lower realized variance in the future after the news event. So then we regress the realized variance 1 day, 2 days, 3 days, 4 days, up to 2 months after the news event. And then we regress it on the implied variance reduction. So all these regression coefficients are significantly negative. So it means that a higher realized variance is negatively correlated with future expected variance. And then second, we want to test whether more informative announcement news is associated with lower returns in the future after the news event. So then we regress the returns 1 day, 2 days, 3 days, up to 2 months after the news event on this implied variance reduction. So again, the regression coefficients are all significantly negative, means that there's a negative correlation between the realized variance on the news day and the future expected returns. So then we go back to our motivating example. So I just said that there's a negative correlation between the realized variance and future expected returns. So then we classify the informational month as at least 1 day within this month is an informational day. Then we regress again this motivating example, this monthly return in the future on the monthly volatility in the past. So the first column was the motivating example. It is significantly negative. But if you're just focusing on these informational month, the regression coefficient is larger and with a higher t-stat, and then R-square also increased to 4%. So it means that the negative correlation between the past realized volatility and future expected return is just concentrated in this informational month. And the rest of the month, you do not see this significant negative correlation. So then to conclude, so traditional finance theorists assume that volatility of the stock market is driven by the macroeconomic fundamentals. So these theories imply there's a positive correlation between the past realized volatility and future expected returns. But we show that if the volatility is driven by information, then their information-driven volatility induces a negative correlation between the past realized volatility and future expected returns. So the intuition is when more informative news must resolve a lot of uncertainty, which triggers large movements in the stock market. At the same time, the remaining uncertainty in the stock market must be smaller, so the future risk is smaller and future expected returns will also be smaller. So then we say it is very important to distinguish the two sources of the volatility, and we believe the stock market fluctuations are more likely to be driven by information. And now, in the end of the day, you learned at least one investment strategy and based on the past volatility and how much you should invest in the market.
So thank you. That was really cool. Assuming that that you prove this out, would the next step be to distinguish between, I'm going to call it clarifying information versus confusing information? Take that or run with it. How does that work?
Yeah, that's a very good question. So basically, we use the implied variance reduction to measure the informative of the news. If you take a look at data, on average, the implied variance reduction will be lower after the information events because the uncertainty can drop significantly. But that's not always the case. So there are some of the times that exactly it's very confusing, so the implied variance can increase. Yeah, that's absolutely right.
And do you have an idea of how you might solve for that in the future? Is that an AI problem? Is that
I cannot solve this problem because I cannot determine what Fed is going to tell us or what somebody else is going to tell us. So we can only observe from this implied variance reduction to see what do the market believe, right? Do the market think this information is very confusing, or do the market believe this information is very informative?
So this might just be a function of kind of what your focus is looking at like the whole market level, but I was wondering if you've looked at any firm-specific measures of information, for example, like earnings announcements, and if you find the same results with something like that.
Yeah, that's a good point. So basically, there are two things, because our theory really works on the aggregate level because the risk compensation is about aggregate risk. So firm level, there are more inducing criteria risks. So it does not hold that well in the firm level. But there are earnings seasons, right? So we know that firms' earnings has earnings season. There are several months that there are more firms have earnings announcement, and then several months they don't. So if you take a look at the earnings seasons and identify these seasons as also informational month, and then our results actually hold as well.
Excellent. If there's no other questions, we'll move on. Thank you very much.
Thank you.